On this podcast, we're going to talk about the problems with the infinite banking concept.
The infinite banking concept is an idea, not a product. The infinite banking concept is a way of thinking about money and finances in a way that allows you to keep more of the money that you make, grow your wealth, and have financial peace of mind.
The infinite banking concept is not a product. That right there, John, is probably one of the first things that we should cover. Many people think that infinite banking is a life insurance policy, or that a life insurance policy is a bank. It is not. The only reason life insurance is associated with infinite banking is that life insurance gives tax-preferred treatment. It allows the owner of a policy to get reasonable guarantees on their money. It provides life insurance coverage, and it allows the policy owner to access their money without giving up guarantees or dividends.
That's why we want to use life insurance with infinite banking concept. They're tools that are used together because they complement each other.
We talk about that in the prescription for wealth, specifically in chapter 4, where we say, you could use a coffee can with money in it under your back porch as your source of capital to practice banking with. But when you do that, you end up losing the dividends, you end up losing the tax-preferred nature, you end up losing the guaranteed growth. And so that's why we use a life insurance policy specifically designed to build high cash values. A lot of people do the infinite banking concept with margin loans or a HELOC. They call that velocity banking.
I don't hear too many people doing that with HELOCs or margin loans right now, though, because
right now.
I talked to a guy just the other day. The interest rate on his variable HELOC is 8.5% interest.
Eek.
Margin loans are even higher than that. I've seen some as high as 12.5%.
And they can increase pretty rapidly, can't they?
They're variable rates. They fluctuate with interest rates.
So this goes back to what you said. It's about how we think about money. And so regardless of where we're getting the capital to use the infinite banking concept in, whether it's a margin account, a HELOC, or in a whole life insurance policy, we have to look at what are the interest rates we're paying for the money that we're using versus what we're getting back by using someone else's money.
Using the life insurance with the infinite banking concept, the growth in the life insurance over time can help to offset the interest that we pay on policy loans when we want to access money and use it outside of the policy. And so by having that growth there that offsets it, you don't get that in a HELOC because you don't own the bank that the HELOC is coming from. You don't get that with a margin loan because you don't own the bank that margin loan is coming from. You can get some of that growth and some of those profits because you do own a part of the life insurance company, which is where your money is coming from when you take up a policy loan.
The other problem with the infinite banking concept is people get confused about interest rates. They believe that if you're paying 5% interest for a policy loan and only earning 3 or 4%, that you're going to lose money. But they overlook the time factor here. Time is important. 3% compounding in your favor will outperform a 5% payment on a loan that every time you make a payment, the loan decreases.
Yeah, that's because on a loan at 5%, as you're paying that loan back, your balance is decreasing. So you're paying 5% on less and less and less. You're earning the 3% or whatever your number is. If we're talking about a life insurance policy, you're earning that on an increasing basis.
Tom, you give a great example of this in Prescription for Wealth, chapter 4, like you mentioned, but you actually go through and use real numbers and break it down where you had money in a CD, and then what if you had borrowed money at a different rate, and you show how that works. And yes, you can use a bank account too for this, deposit your money and then go get a loan from a bank. But are you guaranteed that you can get the loan at the bank? You present, this is what I want. You're not guaranteed that you can get a loan.
Whenever we're talking about compounding too, we have to remember the time period that's involved. You may have a policy loan outstanding for a few years, but how long are you getting the compounding growth in your policy? It's over a lifetime.
That's right.
You have to take the time periods into account whenever you're thinking about a compounding situation.
Another problem that we see with the infinite banking concept is people believe and have been taught by certain people that you can pay your premiums just by borrowing the growth that is occurring in the policy. having a policy loan, paying your premiums is not a long-term sustainable concept.
It's referred to as premium financing sometimes, where you borrow from one policy to pay the premiums on another one because these policies are good, so you want to get more of them. It's also a good way to get over leveraged if you don't have the cash flow to pay back those policy loans at some point. There have been limited cases where we have seen premium financing situations work, but the people always have the cash flow to pay those loans back over time. And that's an important element in any premium financing situation. So yeah, just borrowing from one policy to pay the premiums on another one is not going to create an asset in and of itself.
Sometimes people have a situation where maybe their cash flow isn't good when they get their premium notice. And so sometimes they will borrow from a policy to pay the premium on that policy, but it's not a good long-term strategy. Maybe their cash flow is coming in the next month or two, and then they can pay off that loan that they took to pay that premium. That is a short-term strategy that can work.
Again, this is about how you think about money. So this is a cash flow, a solution for short-term, but not a long-term plan on how to finance more policies or even paying the policy on premium on one policy.
Which brings up another point where people often go wrong with the infinite banking concept. They think, well, these policies are so great, I'm going to max out what I can do in a premium, and they start a little too big.
Or maybe even a lot too big.
Yeah, we've seen it.
Something important is that people need to give careful consideration to the premium amount they're using. But sometimes people get so excited about the infinite banking concept. They just say, oh, I just want to throw a bunch of money in it. And they don't think about what that might cost them long term. They have to really calculate, what am I going to do? And that's where we come up with talking about the 10-20-70 rule, where 10% of your income is a great amount to start with the policy premium.
It's very similar to someone that goes in to buy a house, and they can buy a house that is way over their budget, thinking that they can afford it. And then all of a sudden, a cash crunch comes in their life where they lose their job or they're transferred and they have to sell their house. And now they're in a position where they can't afford the payments on that house. You don't want to start a policy that you know is going to be unaffordable for you or is uncomfortable for you to pay. So the rules here that we always use, is the premium affordable? Is it comfortable? And does it produce the high cash value in proportion to what you're paying in premiums that's going to provide you an asset to do the infinite banking concept?
Sometimes people just kind of want to dip their toe in the water and they pay too low of premiums. And then they look at the numbers and they say, well, that doesn't seem like much of a financial asset at all.
And it isn't.
No.
For what they might want to use it for. Let's say that somebody's wanting to use this for building up assets for their retirement. Well, if they put $5,000 a year in it, there's not going to be all that much there in 30 years. If they will consider the balance with their overall financial picture and really put a sufficient amount toward it, now there's going to be a whole lot more. And they're going to see that, yes, it is an asset. It's just how much builds up depends on how much you put in.
And that makes me think, too, of people that are buying a policy for retirement, and they think that the policy is the infinite bank. And they say, well, there's not very much money there when I get to retirement. Well, we cannot project, and you cannot project exactly how much capital you can recover in your lifetime by using the insurance company's money in the infinite banking concept. Whatever your cash value is, you can compound that significantly if you will do the infinite banking concept. Borrow that money, use that money to leverage, so you can borrow the insurance company's money, put it to work so you can recover the cost of capital that you're losing every time you spend money in your life today.
Another problem that we see with the infinite banking concept is people thinking that you can take a policy loan and just pay it back real quick to make everything grow. And if you're not creating value with that by taking the policy loan, value somewhere else in your life. There's something that you're financing, or there's something that you're investing in, that's what's going to create the real value. Just taking the policy loan and paying it back isn't going to create the value for you.
These are things that we see that are problems with the infinite banking concept, and we're going to talk about the things that you can do to avoid these problems and how to make the infinite banking concept work for you right after the break.
Ken is a client of McPhee Insurance. In 2008, he lost about half of his investments. That was before he was a client, but he had been following conventional financial wisdom to a T. Many people don't put enough money away for their retirement, but Ken did put money away for his retirement. He says the most frustrating thing when 2008 came along, he had been putting money away for 35 years, and it hadn't grown to what he expected it should have. Then 2008 came along, and it took half of it away. He really felt like he was backpedaling instead of making progress the way he should. That's when Ken discovered using life insurance as a financial tool with the infinite banking concept. He says not only does it give him more stability with his finances, but it puts him back in control instead of giving control to somebody else. Many people find out about using life insurance as a financial tool during an economic downturn or a market crash. And while it's good they're getting the coverage they need, we really wish we could turn the clock back for these people so they could have the good life insurance in place before the economic downturn or the market crash. Because good life insurance helps you to keep more of the money that you make, grow your wealth, and have financial peace of mind even during turbulent economic times. To get the good life insurance you need, call McPhee Insurance at 702-660-7000. Call us sooner than later. Welcome back from the break to the most exciting part of the podcast where we talk about how to correctly apply the infinite banking concept. This is where things get fun because when you correctly think about the infinite banking concept, you can keep more of the money you make, grow your wealth, and have financial peace of mind.
So I think the best place to start is to define what a bank is. I mean, we've all used banks or a credit union, but a bank goes through a long process to get its charter. First of all, there's a group of investors that have to come together and save a lot of money. I mean, millions of dollars, 20, 30, 40, 50 million dollars. And then they go to the comptroller of the currency to see if that's enough money to apply for a charter. They also have to go to the insurance company, the FDIC, to make sure that they're going to back them. And once they do that, they get their charter, but now they have to get depositors. And so they have to advertise and they have to hire personnel. There's a huge expense in starting a bank. But the advantage of using a whole life insurance policy is the insurance company has done all of that work for you. All you have to do is fund a life insurance policy with high cash values, and you're in the banking business.
There's three different players in this equation. You have the depositor, you have the banker, and you have the borrower. Most people play the depositor and the borrower all throughout their lifetimes, but they let the banker be the middleman. Because the insurance company has gone through the process of all the capitalization, hiring all the personnel, and all the hard things, very similar to starting a bank, you now get to be a part owner when you buy a policy with a mutual life insurance company. And that allows you to keep some of the profits that the banker would normally keep in the middle section.
Not only do we get to keep those profits, we also get to set up the time factor on how we're going to repay a loan that we took from the depositor and then used in our life as the borrower. That doesn't happen anyplace else, really, that we borrow money. You borrow money from your 401k, they give you specific rules of when it has to be paid back. You borrow money from a bank, if you miss a payment, they come get your car keys. You borrow money from your margin account, and if the market goes down, they do a margin call, and now you're scrambling for money someplace. Doesn't happen with an infinite banking policy. What happens there is you get to determine how that policy loan is going to be paid back. All you have to keep in mind is that you need to pay the interest to the insurance company for using their money on an annual basis.
I think of Jackie and her husband. They took a policy loan and purchased a new vehicle. And they had set up the payment amounts that they wanted to make to pay this vehicle back. But Jackie, in her pregnancy, had to go on bed rest. And suddenly, she wasn't producing income anymore. No one came and got their van when they couldn't make the payments. Instead, they decided to postpone making their payments to the life insurance company. They could do that. All they had to do was pay the interest due in that year, but they could postpone those payments until cash flow was better for them, until Jackie was back up on her feet working.
And that's because they were the middleman. Nobody was telling them when that loan needed to be repaid. They were in charge of those payments, and they could just say, we're going to postpone this until a better time.
Let's talk about retirement. Using your policy right and repaying the loans that you take throughout your lifetime will create an asset that's there for retirement. And as you go into retirement, that can be translated to income, or it can also be translated to help act as a buffer for accounts that might be invested in the market, because when those accounts go down, you don't want to pull income from those accounts. So where are you going to get it from? Why not get it from your life insurance policy? Then it acts as a buffer against what's happening in the market.
And you're talking about using the cash values in your policy all along. Some people think they need to wait until they have a large sum in their cash values to really use. I was talking to a lady the other day. She said, oh, it's going to take 5 years for me to have this lump sum that I want to go make an investment. And I said, but look what you have in the first year. After the first year of making your payments, you have X amount. And I happen to know that that woman has credit card debt, really high credit card debt. And I said, look, you could take that amount and you could apply that towards your credit card. And now you are reducing what you have to pay each month. So you can put more of your capital that you're paying to pay down that loan faster. The light bulb went off and suddenly she realized that that policy could create value for her immediately. And if she will use it in a disciplined manner, that is going to make a huge difference over her lifetime and make a huge difference in her retirement.
Yes, the results will be bigger in 5 years, but she doesn't have to wait 5 years to start seeing those results. It makes me think of a couple brothers, Jeff and Chris. One brother disciplined themselves to start putting money away in life insurance. One brother didn't and actually ran up some credit card debt. The brother that did discipline themselves was able to come in a few years later and help the brother who needs to pay off the credit card debt at a high interest rate, because one brother can take a policy loan, lend it to his brother, and repay his policy loan and make his system continue growing while the other brother gets to get out of his credit card debt now.
That's a win for both of them. But the brother who disciplined himself is in a better position because of the asset he's created.
Definitely.
These same two brothers, the elder one actually was able to splurge in his life and buy something that is very dear to him, and that is a grand piano, simply because he had disciplined himself to put money in life insurance. And now he's at a position where he said, wow, it would be a struggle if I just had to make this payment to, the bank for a loan to buy this grand piano. But if I can structure a loan by borrowing it from my insurance policy against my insurance policy, guess what? I can afford this piano now. And he did.
Another family who are clients used their life insurance as a buffer during 2020. They had accumulated money there, and when their business had to shut down, they didn't have to worry because they knew they had a cash cushion in their life insurance. So they used that money as a buffer, and now as times are getting better, they're paying that buffer back. So it's there for them if something else happens in the future. Repaying those policy loans is a very important part of the infinite banking concept, because we can just pay the interest on a policy loan for a time, and sometimes we need to do that for a time. That's part of the flexibility that we have. But we want to get those policy loans paid back so that buffer is reestablished for us, the capital that we're using. Because if we're always paying interest on that policy loan, then that's going to detract from our overall benefits.
We could go on and talk about clients who have used their policy cash values to purchase businesses, start businesses, expand their business, pay for weddings, education, travel, home repairs, all kinds of things. And that's the infinite part of infinite banking. And it takes imagination. Whatever your situation is, you can use the infinite banking concept to benefit yourself financially.
If we were to summarize all of this, I think we can say that the infinite banking concept allows you to have your money working in two places at once. In the life insurance policy where it continues growing, and wherever you've taken a policy loan to use that money outside the policy as well.
Above all else, remember that the infinite banking concept is just an idea, a good idea. It's how you put the idea into practice that's either going to make it problematic for you or powerful.
If you have questions about the infinite banking concept, put your questions in the comments or send an email to producer@wealthtalks.com so we can answer your questions right here in the studio.
We've answered a lot of good questions about the infinite banking concept over the last 17 years. So send us your question if you have one, and come back next week for an episode on how to fund business expenses with your life insurance policies. That's what we're talking about next week, right here on Wealth Talks.